Critical Man Pictures presents the Forex video training series. Black Belt Second Degree using Equities to trade Forex. Do you know that the equity markets can be used to help gauge currency movement? In a way, you could use equity indices as some kind of Forex crystal ball. Based on what you see on television, what you hear on the radio, and what you read in the newspaper, it seems that the stock equity market is the most closely covered financial market. It's definitely exciting to trade since you can buy the companies that make the products you can't live without. One thing to remember is that in order to purchase stocks for a particular country, you must first have the local currency. To invest in stocks in Japan, a European investor must first exchange his euros into Japanese yen. This increased demand for Japanese yen causes the value of Japanese yen to appreciate. On the other hand, selling euros increases its supply, which drives the euro's value lower. When the outlook for a certain stock market is looking good, international money flows in. On the other hand, when the stock market is struggling, international investors take their money out and look for a better place to park their funds. Even though you may not trade stocks, as a Forex trader, you should still pay attention to the stock markets in major countries. If the stock market in one country starts performing better than the stock market in another country, you should be aware that money will be probably moving from the country with the weaker stock to the country with the stronger stock market. This could lead to a rise in value of the currency for the country with the stronger stock market, while the value of the currency could depreciate for the country with the weaker one. The general idea is strong stock market, strong currency, weak stock market, weak currency. If you bought the currency from the country with the stronger stock market and sold the currency from the weaker stock market, you could potentially make some nice dough. Not too familiar, are you, with the major global equity indices? Your lucky day. Here they are. Dow Jones Industrial Average, or Dow for short, is considered to be one of the premier stock market indices in the U.S. It measures how well the top 30 publicly owned companies are trading. Despite the name, barely any of the companies have anything to do with industrial production and are instead representative of some of the biggest companies in America. It's closely watched by investors around the world and is highly indicative of market sentiment, thus making it sensitive to both local and foreign economic and political events. The companies that are part of the Dow are so large you probably deal with at least one of them every day. Imagine life without AT&T, McDonald's, Pfizer, or Intel. Yes, these all companies are listed on the Dow. S&P 500. The Standard & Poor 500, more commonly known as the S&P 500, is a weighted index of the stock prices of the 500 largest American companies. It is considered to be a bellwether for the American economy, as it is used to predict its direction. After the Dow Jones Industrial Average, it is the most traded index in the U.S. Some mutual funds, exchange-traded funds, and other funds such as pension funds are designed to track the performance of the S&P index. Hundreds of billions of U.S. dollars have been invested in this fashion. NASDAQ. NASDAQ stands for National Association of Security Dealers Automated Quotations. It refers to the largest electronic screen-based equity security trading market in the U.S., comprising of approximately 3,700 companies and corporations. It also boasts of having the largest traded volume among the world's stock markets. The Nikkei. Similar to the Dow Jones Industrial Average, the Nikkei is the most widely quoted average of Japanese stock market. It's price-weighted average of the top 225 companies and is supposed to be reflective of the overall market. The Nikkei includes companies like Tokyo, Japan Airlines, and Fujifilm. DAX. DAX is short for Deutsche Aktien Index. You're probably better off remembering it just as DAX, though. It's a stock market in Germany that consists of the top 30 blue-chip companies that are traded on the Frankfurt Stock Exchange. Germany being the largest economy in the Eurozone, the DAX is normally a closely watched index within the whole Eurozone. Some of the companies that are part of the DAX include Adidas, BMW, and Deutsche Bank. DJ Euro Stoxx 50. The Dow Jones Euro Stoxx 50 Index is the Eurozone's leading blue-chip index. It comprises over 50 top sector stocks from 12 Eurozone countries. It was created by Stocks Limited, which is a joint venture of Deutsche Börse AG, Dow Jones and Company, and 6 Swiss Exchange. FTSE, pronounced FTSE, the index tracks the performance of the most highly capitalized UK companies listed on the London Stock Exchange. There are several versions of this index, such as the FTSE 100 and the FTSE 250, depending on the number of companies included in the index. Hang Seng. The Hang Seng Index is a stock market index in Hong Kong. By recording and monitoring the daily price changes of the stocks included in the index, it tracks the overall performance of the Hong Kong stock market. The index is currently complied of HSI Services Limited, which is a subsidiary of Hang Seng Bank. One issue in using global equity markets to make Forex trading decisions is figuring out which leads which. It's like answering the question, which came first, the chicken or the egg? Are the equity markets calling the shots, or is the Forex market that wears the pants in the relationship? The basic idea is that when a domestic equity market rises, confidence in a specific country grows as well, leading to an inflow of funds from foreign investors. This tends to create a demand for the domestic currency, causing it to rally versus other foreign currencies. On the flip side, when a domestic equity market performs terribly, confidence falters, causing investors to convert their invested funds back into their own local currencies. For the past couple of years, however, this principle holds contrary for the U.S. and Japan. Any upbeat economic figures in the U.S. and Japan more often than not weigh down their respective currencies, the dollar and the yen. First, let's take a look at the correlation between the Dow Jones Industrial Average and see how the stock markets all over the globe perform relative to each other. Since the turn of the century, the Dow Jones Industrial Average and the Nikkei 225, the Japanese stock index, have been moving together like lovers on Valentine's Day, rising and falling at the same time. Also notice sometimes one index leads, rallying or dropping first, before being followed by the other index. You could say that the stock markets in the world generally move in the same direction. The correlation between currencies. Before the global economic recession that started in 2007, when most economies suffered consecutive quarters of negative GDP growth, the Nikkei and the US dollar-yen were inversely correlated. Investors believe the performance of the stock market reflects the status of the country, so a rally in the Nikkei led to a strengthening of the yen. The opposite actually held true. Whenever the Nikkei would drop, US dollar-yen would rise as well. When the financial crisis hit, however, the relationship just went crazy. The Nikkei and the dollar-yen, which used to move oppositely, now move in the same direction. Amazing. Who would have thought the stocks have something to do with the foreign exchange market? The correlation between the dollar-yen and Dow. Let's take a look at the correlation between the dollar-yen and Dow. Based on what you read earlier, you might assume the dollar-yen and Dow would be highly correlated. However, a look at the chart below would tell you that this isn't quite the case. While the correlation is positive, it isn't as strong. Take a look at the Dow, blue line. It peaked at 14,000 late in 2007 before dropping like a hot potato in 2008. At the same time, dollar-yen, orange line, also fell, but not as sharply as the Dow. This could serve as a reminder that we should always take into account fundamentals, technicals, and market sentiment, so always read up. Don't take correlations for granted because they aren't a surefire thing. The euro-yen. As we said earlier, in order for someone to invest in a particular stock market, one would need local currency in order to purchase the stock. You can imagine the effects of the stock market like the DAX, that's the German stock market, have on currencies. In theory, whenever the DAX rises, we could probably expect the euro to rise as well, as investors need to get hands on some euros. While the correlation is imperfect, statistics show that it still holds pretty accurately. Do a little research on the euro-yen seems to be highly correlated with stock markets across the globe. You should know that the yen, along with the US dollar, are considered safe havens among the major currencies. Whenever confidence in the global market is down and traders are fearful, we typically see traders take their money out of the stock markets, which leads to a drop into the values of the DAX and the S&P 500. When money flowing out of these markets, we usually see euro-yen fall as traders run for cover. On the flip side, when the sun is bright and risk appetite is rampant, investors pour their money into stock markets, which turns to a rise in the euro-yen. Take a look at the chart to see the correlation between the euro-yen and the DAX and S&P 500. The correlation seems to have held well in the past decade. Euro-yen and most indices rose steadily together until 2008, when we were hit with the financial crisis. In late 2007, Euro-yen had hit its peak, and so did the stock indices. If you want to see the raw data for yourself, check out Yahoo Finance. It is a great place to start digging and doing your own research. The site offers historical price data for almost all currency pairs and equity markets. You can compare historical prices and come up with your own barometers of risk.